There's a common saying that time flies when you're having fun, but in the financial markets, time flies when you're making gains. And this last quarter has truly flown by, with almost every major index in every country seeing extremely positive upside flows. So what comes next? This is the question on everyone's mind, and today I bring you the stats as to what we can expect to come next for 2024, and the results may actually surprise you. We're also going to be talking about risk, what is cheap, what is expensive, and what you can add to your portfolios to hedge against any incoming volatility. The market is never stagnant and we need to be prepared for anything and everything. So we've got a lot to talk about, so sit back, relax, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. A very mixed / red day here today. We had some pretty big winners, stuff like Tesla, MU here in semiconductors outperforming, as well as Google in comm services, but pretty red everywhere else. Industrials were kind of flat, led lower here by railroads. Healthcare was pretty green. Consumer staples as well. Utilities very red, and I think the market is just getting a little bit jittery with regards to valuations, PCE coming up, some of the data. That's why we're seeing a bit of rotation into some defensive names like healthcare. They were pretty green on the day, out of stuff like semiconductors, maybe into more value orientation, stuff like banks. But in a shortened trading week where fund managers take this week off, sometimes volume can be really high at the start of the day, really low towards the end of the day. Things can look a bit weird in weeks such as these, but looking at sectors, guys, so we saw healthcare perform the best, XLF as well, and then software. But software doing really well didn't help technology. Technology was down 0.41%, right above real estate. All in all, we did see some form of a safe haven defensive buying today. Look at staples, healthcare, GDX as well, and they all outperformed the SPY. The worst performing sector was utilities, very weird, and then semiconductors in second place right there. But there wasn't really much to go off today. I would definitely say we did see a bit of a defensive, a bit of a safe haven buying spree, but again, to really call it anything more than just a liquidation, you would really want to see a number of days, even possibly weeks of defensive buying. And I think this was just one notch in the road. But let's hop on the charts and talk about price action today. So almost all of the indices finished red today. The S&P 500 nasdaq down 0.28, 0.36%. The RSP only down 0.1, mid caps 0.18, and then the S&P 600 small caps down 0.15%. So high beta outperformed large size. Very interesting. Now have a look at this. Futures are actually up in after hours for S&P 500, Nasdaq 100, and the RTY. VIX didn't move that much today, so volatility was slightly elevated, nothing to write home about. And then we had bonds moved slightly up, which means yields were lower. I guess that supported mid caps, and then Bitcoin, gold, not really doing much of anything, down 0.44%, which weighed on energy. All in all, a pretty red day across the board, but very interesting to see what's happening in after hours. Let's actually hop on the chart here. This is the S&P 500, and these are the levels we've been looking at all week. And I've pretty much said, we should find support at these levels right here or right here, and we actually haven't reached it for the week yet. I mean, this is the start of the week right here on Monday. This is Tuesday, and even though this is a red bodied candle, yes, and we closed the day at the lows of the day, the range is still pretty muted for the most part, and you can actually see that based on where we opened, we did have quite a lot of price discovery above, and for most of the day we were actually in the green because of the gap up. Now let's actually hop on the 5-minute chart. We gapped up, right, and we were quite a lot in the green here in the S&P 500. If we actually go ahead and measure that from the gap up to the open candle or to the high, we're up 0.3%. Now for a day's trade, that's a lot for the S&P 500. I know it can get pretty volatile. Then we sort of had this top here, and then sellers, kept selling us down, and then the sell momentum continued. Buyers came in a little bit right here, but then sellers continued, took us all the way down, where the market just absolutely dumped in that last 30 minutes of trade. And this right here is all zero DTEs. When you have sort of like negative flows after a massive gap up, dealers need to hedge by selling their position, and this is exactly what happens. Very interesting stuff. But on a daily chart, you then look at it and it's not really a big deal. It would be a big deal if there's follow through tomorrow. However, look at futures, okay? We're in the green already quite significantly, and only a couple hours after the official market has closed. So, until we actually start getting to these levels here and then maybe breaking below, that's when we could start getting worried. But, we're above the 51.81 level, and this was where we really wanted to buy for the week. It's just taking us a couple of days to get there. We might even get there tomorrow. We might see another red day tomorrow, but until we get to this level, there's nothing really to worry about in this market. We're just having, a red week in what has been a very, very positive year so far in the S&P 500, and it happens. It happens. Sometimes we have red weeks, guys. It's how the market goes. But we are still technically in the window of weakness, guys, which means that dealer supporter flows are not quite there. Going back to this 5-minute chart, if we were not in the window of weakness, I guarantee buyers, right, dealers probably step up right there before moving higher instead of going all the way down. And that's just what the window of weakness does. The supportive flows of dealers are not all there. But all in all, guys, I wouldn't read too much into the price action today. There really wasn't much to talk about. It was just another red day in what is a shortened trading week with very, very weird volumes across the board, not consistent volumes across the board, and we're not even at our key levels for the S&P 500. So, just sit out the volatility today. I mean, we're already green here in after hours. We'll see how that translates into trade tomorrow, but all in all, not much to say. Just wait for levels 51.81 to buy, 51.32 if we do break below. But until we actually get, below here and have price discovery below, there's not much to do in this market other than wait and buy dips. Now, guys, let's dive into some stats. Very interesting stuff. So this is forward returns after 5 consecutive positive months, and the months I've used are November to March right here. So we haven't finished March off. On Friday or Thursday when the market closes, we'll see what this gain is going to be. But generally speaking, if we have 5 consecutive positive months, these are the returns we can expect in April, the rest of the quarters of the year, the last 9 months, and then everything up to 12 months after. And April tends to be very positive as a result, up 1.9% here in April, 2.9% in Q2, 1.5% average return in Q3. Do take these numbers with a grain of salt because the percentage up is not that great. The hit rate is not that great. So what we can actually see is a little bit of weakness here in the third quarter as well as the second quarter. Maybe we actually get those dip buying opportunities in these quarters of the year. Then we normally see a very, very positive Q4. And that leads us to the last 9 months normally being positive by 11.9%, the full year 22.1%, and then the next 12 months are from April to March of 14.5%. And the hit rates here are very, very good, 91%, 100%, and 100% of the time it is higher. So in other words, what this data is telling us is you don't have to actually just buy the dip. You could just buy right now, hold, sit through the volatility, and maybe add to your positions in Q2, Q3. Maybe if you're more risk averse, you could wait for a dip in the second quarter or third quarter, but it might not likely come because as you can see, the average gain actually is 2.9%, 1.5%. That being said, the data is here. It hasn't triggered yet. We do have to finish March on a positive note, and that means we have to avoid a decline over the next couple of days of about 2.5%. We do that, this is going to trigger, and we can actually expect more gains in 2024. Now, looking at another bullish indicator, this is the quiet strength indicator. I'm just going to read what it is. Essentially, it's the sum of the number of days in the past week with a less than 1% swing on the S&P 500 and the number of days with new highs beating new lows. And then they graph this on a scale from 0 to 10. And normally we stay above this 10 range for very long periods of time in bull markets. And look at what we're doing right now. We're in this 10 range, and this means that the market can continue rallying for a very long period of time. You take into consideration though that this is a very, very long time frame going back to 2015. It's more of a longer term bull market indicator, and you could see based on where we were here in 2022 versus where we are right now. And this just technically means it's a great time to buy equities. Yes, volatility will peak its head in the market, but all in all, this is a very, very bullish sign and a very, very bullish indicator looking past 2024, 25, 26. Now let's actually have a look at earnings beyond 2024. So this is Goldman Sachs top down, and then consensus S&P 500 forecast. Now they've removed financials, real estate, and utilities from this list. I don't know why, so do take this data with a little bit of grain of salt, but we can still look at it regardless. So for 2023, Goldman Sachs have seen 3% sales growth, 11.1% profit margins, and adjusted earnings per share of 223. Now including this right here, we're actually looking at 229. So we have had quite a bit of growth from 2022 to 2023 if you include these sectors right here. Now looking at 2024, Goldman Sachs expects 6% sales growth, margin expansion to 11.5%, 241 EPS, 8% growth. In 2025, 4% sales growth, 11.7% margin expansion. So margins expanding every single year. That's crazy. For 256 EPS, 6% growth. Consensus is far more bullish. 243 EPS, 9% growth. 276 EPS in 2025, 14% growth. And margins to expand as well to 11.7% from 11.1 and then 12.6% in 2025. And in an environment where revenue is going up, earnings are going up, and margins are also going up, you want to hold equities. This right here, guys, is very, very bullish, especially profit margins. That literally translates into billions of dollars of free cash flow, which can be used for dividends, buybacks, acquisitions, and further growth. So very bullish stuff right here. And this is a reason you want to hold equities, because earnings are coming in really, really good, as well as margin expansion. Now, Q4 beat rate has actually come down from its record, but we're still at historically high standards here at 78. And we exclude this 2022 situation because the government injected $1.7 trillion worth of money. You can actually see it's very, very rare for us to beat above 78%. That's what we did this earnings season, and this is very, very bullish. So earnings are coming in good, better than expected, and earnings are growing and expected to grow. This is what you want to see in bull markets. Now, valuations are stretched. We do know that the S&P 500 right now trades at a 21 times forward, and this means that equity risk premium is probably not all there. Probably some of the lowest risk premium we've had in a very long time. And you can see the US, the worst out of every index in the world, trading at 2.6% ERP. And essentially, this is what investors expect to get over the risk-free rate in the long term, 2.6%, which implies anywhere from a 5 to 6% annualized return in the S&P 500. The best is Asia Pacific, excluding Japan, at 6.8% right there. And then you also have stuff like Europe at 4.1%, doing really, really well. And I think we covered in yesterday's video, this is why fund managers are looking at Europe. Everything just looks attractive from a Europe standpoint, from valuation, price. And this is why fund managers are rotating into Europe. We covered that in yesterday's video, because Europe just looks attractive in whichever way you look at it. All in all, the entire world is trading at a 3.9 equity risk premium. And this doesn't necessarily mean you need to sell equities, but you probably want to be very selective with the equities you are buying. That being said, if you go back to like the early 90s, early 80s as well, equity risk premiums were significantly lower, sometimes even in the negative. And that was some of the best times to hold equities, was through those periods, especially in the mid to late 90s, when you could see that equity risk premiums were like less than 1% here for the global market. That being said, if risk premiums are so low, does that mean bonds are a good buy? The question is probably yes. This is current asset valuations, treasuries, and S&P 500 against history. You can see that the S&P 500 not trading the most expensive it ever has, but still up there compared to 2021, compared to the dot-com bubble, and compared to history as a whole. Then we have a look at treasuries trading right here. Relatively speaking, compared to history, trading very, very cheap. Trading at the same levels it was here in 93, 95, 98. Very similar levels. If you do want to add bonds to your portfolio, not a bad idea just to, collect the income and really diversify away from equity risk, especially considering the fact that bonds tend to do really well after Fed pauses. You can see here that 6 months after the Fed pauses, we normally get exceptional returns in bonds, very close to the double-digit returns in all of these instances. We do know that the average Fed pause lasts about 5 to 8 months, and then if we actually extrapolate these to after the pause, next 1 year, next 3 years, you could see that 8% returns in the year after, 13, 17, 14%, and then in the 3-year figure, these are annualized, 10% returns, 12% returns, 10% returns. So to diversify your portfolio a little bit away from equities into bonds, with where bonds are right now, considering how attractive they are relative to history, actually not a bad move at all, and might actually be good for overall portfolio volatility looking 1 year, 3 years into the future. Now, looking at the macro, some very interesting data. So we do know that the Fed last week changed their inflation goalpost. They were hardline at 2%. Now they're looking at 2 to 3%, a very, very big change right here. And that means that inflation data is not really going to affect the market as much, because we do know that between 2 to 3% is the Fed's new target. So everything is now going to move to the unemployment rate. And I think the market is going to look at that for recession risk. Now, this is the average annualized S&P 500 change for all months since 1954. So this is on an annualized basis when the Fed cut the funds rate and the unemployment rate declined or rose. So you can see here that when the Fed cut rates and the unemployment rate declined, the S&P 500 returned 17.4%. Very, very bullish stuff. But if the Fed cut rates and unemployment rate increased, we only saw a 4.7% gain. And that means that there were years when we were up pretty big, but there were years when we were also down pretty big, compared to this where, yeah, we would have had down years for sure, but it wouldn't be nearly as much when the unemployment rate rise. So that's what we want to look at over the next 3 to 12 months, especially when we do get that first Fed rate cut. We want to look at employment data. We want to look at jobless claims, JOLTS, non-farms in particular, and we want to see, is there deterioration in the jobs market or is there improvement in the job market? Now let's talk gamma. Now we've had some major changes in the gamma tape here, guys. So firstly, the gamma flip zone has actually moved up to the 5190 area, very close to the 5200 area. The reason that's happened is because we've had a ton of negative gamma come in here at the 5250 level, and I think this here is just a bunch of people hedging into the PCE data we're going to get later this week. That being said, we have to play the game as it is, and right now we're still in positive gamma, and we still want to look to 5300 as a core gamma resistance and the ultimate strike we want to aim for into April OPEX. Now 5300 is not too far away from the current price, and if it does move up, that's the next strike we'll aim for. We can see that the 5400 strike is getting built out quite a lot. It's the second biggest strike. Also, something to note, right above the gamma flip zone is this huge amount of positive gamma right here. So that should support the market. But let's say for whatever reason we are to break below this level right here, this gamma flip zone is going to be a very, very strong resistance zone that could offer resistance for the bears if we do get below it. So 5200 this week is a very key level, especially looking into PCE. And if we do like sell off into PCE, let's say PCE data is released and like we gap down into this area right here and then rally, find resistance right there, move down, then you could maybe say that we could see some bearish momentum in the market, especially week after next. But we are in positive gamma. You want to buy dips, sell rips, take advantage of opportunities that do come your way, and look to the 5300 strike, and as it is right now getting built out, the 5400 strike. Now let's talk seasonality. This is the S&P 500 election year versus 2024. This is every single election year group, and this is what we're doing right now. You can see on a year-to-date basis, we're not even the best election year. However, we're definitely up there, and normally what you can tell from this chart is wherever we are right here, we normally do finish higher, so we can actually expect higher price action in the S&P 500, and any major dips we do get in the market, and we will eventually get them, you want to buy those and look to higher price action, because election years are normally very, very bullish. You could see here that the only time we had a major drawdown in election year was 2008, right here in 1960, and then in 2000. And even this was a 3% down year, an 8% down year, and this was the GFC. Now, grouping all of these election years into one, we get this composite seasonal cycle right here, and what we've done in 2024. And you can see that we are way, way above the average trend. And normally we have this volatile period here in March where we par a lot of the gains we've made for the year. We have not had that. And we are now in a period where seasonality becomes a tailwind for equities. And does this mean we can go higher? Absolutely. But normally do get a little bit of bullish momentum as well, and then sideways action, and then we normally rally. So if we sort of go like up and then sideways and then continue the rally sort of here in June, late May, don't be surprised, that can happen. That would be well within seasonality. But that being said, pretty much from here on out, seasonality is a tailwind for equities. And man, that could mean even higher price action for the S&P 500, which is crazy to think about. Now, looking at some bellwether indices, this is home builders, home construction versus the S&P 500. And you could see we had resistance here, home builders coming out of this massive base. Very similar situation in home construction. Resistance, 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 resistance turn to support right here. Resistance turn to support right here in home builders, and it's off to the races, new multi-year highs. And if home builders are rallying, that means the economy must be in good nick. And generally speaking, in an environment like this, you want to be long equities. Now, looking at the New York Stock Exchange Composite, we continue to make new highs against new lows in the index, actually approaching some of the highest highs we've seen since 2021. Now, this isn't a reason to be bearish. This is a reason to be super bullish, because when we see highs normally increase quite significantly, normally leads to massive rallies in the stock market. And actually the only time we really derail in the market is when we have huge events like the Rona crash. And this right here, okay, this was actually caused by the government's injecting $1.3 trillion in 3 months into the economy. But you can see that we were very much on track here in early 2020 leading up into it. Then we had the pandemic and Bob's your uncle. But normally speaking, in any normal environment, this is very bullish. Looking at the risk on risk off indicator, you can see we used as resistance turned to support, off to the races, and this favors risk assets. And I would say that anything above this line right here favors risk assets, and any pullbacks we do get in growth, you want to buy those dips, look to higher price action. And this right here was a brilliant time to accumulate stocks and risk on assets. Looking at staples, low volatility versus the S&P 500, and in bear markets, these go up. In bull markets, these go down, and we're breaking key levels of support, as you can see right here, support which was resistance, and that favors growth, it favors risk on assets, it favors high beta, and do expect those to continue to outperform, at least until we get some of these key levels right here in these indices. Looking at the bellwether stock index, so this is pretty much a bunch of equally weighted stocks right here, and essentially if this is going higher, it means the economy is good and you want to own stocks that'll benefit from a strong economy, and that's high growth, that's high beta stocks, less staples. And you can see right here, we've made a new all-time high. Resistance didn't become support, but we did break above this resistance, which is just as good. And off to the races, you want to own stocks that'll benefit from a strong economy based on the bellwether stock index. Looking at data in the week ahead, so tomorrow we only have mortgage applications, and then Thursday we have initial jobless claims, GDP data, that's going to come in at 3.5%. BOFA estimate, consensus is 3.2%, and then we have the big stuff, Michigan sentiment, PCE data month over month, headline and core, and that data is on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.